We are going to talk about the double bottom pattern. This pattern is occurs quite uh, hap- occurs quite on a regular basis in chart markets. This is unlike the cup and handle pattern, which I had explained in an earlier video, which is not that this pattern occurs quite often, unlike the cup and handle. Now I've got cherry pick charts, obviously. And I've got these for the Nifty 50 itself, so I didn't have to look through the Nifty 500 for this. So we've got SBI Life here, and we have got price here that's going from a higher, it's gone to higher high and higher low. If you see here, the pivot here is a higher low compared to this low, and it's a higher high compared to the high here. So it's a swing high, higher swing high, higher swing low, and then price goes down for a bit and then goes up. Now, it would seem that the price is basically consolidating here. So, talking about the double bottom pattern, price has gone up for a bit and then sellers want to bring it down. People who got in here at the bottom or at this line, for example, this support line, this resistance line, which turned into support, they are basically booking profits. So, I will just use trend lines here to show you from here to here. Then from here to here, you see it's almost kind of the same. The leg is the same. Then you have your middle here. And let's connect this here. And you have your, so prices have gone up. Sellers try to bring it down, the first leg down. The bulls fight back. They go up to here and they tried to go up to here, but they went up to here. If you see a couple of candle wicks here, couple of highs here. Then they went down here. Sellers again tried, and the bulls basically pushed back. So this is a one bottom and second bottom. So that is why it's called double bottom pattern, and it's also referred to as a W pattern because speaking a W as in the English alphabet language. Now the way here to approach this pattern is that sellers have already tried once, they've tried twice, and as per human behavior, market psychology, bears or bulls will try at least twice before giving up for a short time before they try again. So the bears tried, the bulls pushed it up, and the bears tried again. They didn't want to lose this price point, and the bulls went up. Again, sellers tried now, but now they are not that strong as they were because they were earlier able to push it up to here. But now price found support at the 20 EMA and prices bounced back. Now, how do you trade this pattern? Trading this double bottom pattern basically is trading this double bottom pattern basically is that you basically, I'm going to draw a horizontal line here. This is going to be the place below which you will place your stop loss. Your stop loss has to be below this. You can keep it a few paisa or a rupee below this, uh, or you can choose ATR, again up to you. This would be the stop loss here because prices bears have already tried. So and price is bouncing off. So if you see the spike here, it would be preferable that you place it below the spike for give it some buffer. Again, up to you how much buffer you want to give. And where would your entry be in this pattern? Assuming that you are not part of this rally, this rally, this rally, this rally, this rally. Okay. So it's rally, drop, rally, drop, rally. So your entry would be uh, above the neckline here. I'm going to make this green just so that it's clear that we are going to take an entry above this. When price breaks above the neckline, you would go in for an entry. You put in a stop loss or a limit order here, where you cross the neckline. Your stop loss is below here. And what is your take profit? Your take profit basically would be the bottom, these two bottoms up to the point here. Now, up to this point here, where you have made, where the middle of the double bottom pattern is. And remember, this can be a high, can be a close, up to you. You can basically see if there are a couple of wicks here, we've taken those 2 wicks here. You can tell me, Neeraj, why don't you take it right up to this high? Yes, you can take it up to there, up to you, up to you. So your your target would be the bottom. And remember, these bottoms, while they are looking exactly textbook, they need not be. The bottom can be 3 to 4% up or little up or little below. Little below is fine, little up is also fine, little up is even better, simply because in the first leg they went up to 1368, and if they are not able to even come here, that means the bulls are overpowering them much before an earlier prior support. So 3 to 4% here and there is fine. And while this appears textbook, all patterns, they can go a little up and down. Okay. So don't be so rigid that you start discounting a pattern just because, "Arey, this bottom is not the same as this bottom." Okay. So this is your target from the bottom, from the two bottoms up to the middle of the of 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 this pattern. Remember, this is not going up to the neckline like in other patterns, but only going up to the middle. So what I'll do is I will take this and place it here. Assuming you took entry somewhere above this green line, from your entry, this is your target. Now, if I place it's coming up to 1586. So I can say something like 1586.3 is my target. 1586.3 coordinates are 15863, and I have to text is there. Target is 158. Ah, okay. I didn't see that. Yeah, it's here. This is just again, if you do this, what happens is, suppose you've got 4 or 5 trades in play, right? Now, are you going to remember everything? I assume you're maintaining a trading journal, but still, or a notepad or an Excel or something. If you write here, now if you're on your way to work and you just want to look in on the trade as to what's happening, where are you going to refer to all these notes? So you have TradingView installed on your mobile. All you need to do is you have your long here. You can put in your your stop loss here. You can, sorry, I'll make this green. I'm sorry, I'll make it red. Red stop loss is a little below this. So obviously you can write something like stop loss and the exact rate. You can keep it here. You'll obviously keep it here below this wick and whatever buffer. The stop loss may be something like this. Okay. You can keep your stop loss somewhere like this. You will drag it a bit below as to your buffer, little below this wick, and you'll write the rate here, just like I've written here. Stop loss this, target this, and you can drag this entry to whatever, and you can also write entry at so and so rate, which will be above the neckline. So whenever the price goes up and down, you exactly know what's happening. For example, here there is price went up, came down, took resistance, took support basically at the 20 EMA, almost came up to the 50 EMA, then bounced back. Then you have a green candle, then again up, 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 and some consolidation, and then again you have this doji candle. Price not going anywhere, and a big spike, but buyers pushed it up. It only managed to touch. Um, almost came close to the EMA 20 1470.2, whereas the EMA 20 is 1464. So it came, but EMA 20 is so strong, and then the price is going up. And once your entry is confirmed, you place your GTT order for one cancels another, and you have your target or your stop loss. As the price starts moving up, certain traders would like to save their profits. So you can bring your stop loss from here, and you can trail your entry if you wish to do so, or you can keep it here to allow price action to have a buffer. When it goes a little further up, then you can bring it up to break even, or you can trail it at a 3-day, 5-day candle low. But I suggest that you please keep buffer, because even if you have kept a 3-day, 4-day candle low, chances are you would have been taken out, and in all probability, in a few days' time, you're going to hit your target. So again, see, this is a learning journey. There are no right or wrong answers, and everybody who's there in the stock market, uh, they'll always be they'll always be unhappy. Either they sold too early, or they sold too late. Either they didn't trail the SL, or if they trail the SL and the SL got hit and the price moves in the direction, again they're unhappy. So people are always going to be unhappy. Now there'll be two types of unhappy: one with some profits in the bank, and some without any profits. So again, every trader, every strategy, you are going to have your own learning journey, and this is a journey of a lifetime. So as and when you start taking hundreds of trades, 50 trades, 100 trades using a particular pattern, your intelligence and your maturity grows, and you start tweaking the rules taught by me or anybody else, or any other books written by big traders. There's nothing like the perfect, there's no holy grail. All patterns fail and do fail. Even the most reliable patterns will fail. But the question is not failure in a particular trade. The question is, do these patterns succeed over a number of trades? If they succeed, then you're good to go. You don't need to succeed in every trade. All you need to do is have a comfortable winning margin. Your average winners more than your average losers. And if your R multiple over a course of 100 trades is more than 1, you are going to make money. You can even make money with a 30% win rate. Now you're going to ask, how are we going to do that with a 30%? Yes, you can. If your R multiple is higher, you can make money even with the 30% accuracy. If you have a 50% accuracy and your win ratio is 1 is to 2, you still make money. 10 trades, on 5 trades you make 10 bucks. On 5 trades you lose 5 bucks. So net net you make, how much do you make? 10 minus 5, 5. So you still made 5 out of 10 trades. Just being very simplistic here using a single rupee. So all patterns, you have got to basically backtest and see what patterns give you better probability and go for those. There are multiple patterns in the market: double bottom, um, triple bottom, up and handle, ascending triangle, inverse head and shoulders. I'm just giving you long patterns. There are many, obviously, short patterns also, but since I'm talking equity and a long trade in equity, I'm just telling you this. Okay, now let's go to Tata Steel. I digress for a bit, but again for your benefit. Tata Steel here. So where is Tata Steel? Tata Steel is here. It's gone down for a bit, went up, came down, higher high, not a higher low, then went up again. Now you have a higher high, but then the price is coming down. Price took support here at the EMA 50 and consolidated and blah blah blah. So this price is is basically slowly going up and down with some consolidation. Now, where do I see the double top pattern here? You may say, where is the double top? This guy Neeraj is not able to see properly. But let me show you what I see. You will also be able to see this if you see charts long enough, hundreds of charts over a period of time, you will start seeing patterns. It's not easy, but it's not impossible. I repeat, it's not easy, but it's not impossible. Practice makes perfect. Now, there's no perfect in the stock market, but close enough. The more you practice, the more you will accurately detect patterns, and the higher the chances of you utilizing these patterns to make money. And while knowing patterns is good, your ultimate aim is not to be a chart master. Chart master is a means to an end. You are in the market to make money and to make money peacefully, and to become financially free as quickly as possible and remain financially free, and from financial freedom go to higher and higher net worths. I'm not there yet. You're also not there most probably. So let's try to figure this out together. Now you see this W pattern. There is a W and there's a W. This bottom is lower than this bottom. So let's look at this bottom. 129, 128. No big deal. No big shakes. Hardly 1%. Not like the 4% that I told you, right? So you'll say, Neeraj, what is this, man? I mean, is this a W pattern? Or is this like the W pattern is taking a drink and it's falling, and slowly it's going to fall here on the right side? No, my friends, it's not like that. Like I told you earlier, and if you watch my videos, you are not going to get textbook patterns exactly in the market, but close enough. Close enough is good. So you have bears one leg down, bulls fourth back, again a bear second leg down. Then again you see here this red candle. They've tried, but you have the bulls reversing what the bears. You have the bulls reversing. You have a bullish reversal bar right next to the bearish reversal bar, and you have something here. So, like I said in the earlier chart, we are going to make a neckline. Now, if you see this neckline, you can extend it a little higher if you will. I'm going to place a horizontal line here. This is your long entry. You have to take a long entry above this. You have to place your stop loss below this bottom, like I explained earlier. And what is your take profit? Your take profit is the line between the bottom up to the center of the pattern. It's showing around 7.63%. And let's copy this and above your entry. So you would have achieved your target here. I'm going to make this a bold green. Can I make it bold? I'm going to make this I'm going to write text here because I'm going to say your target here, and I'm going to make this yellow so that it's a little differentiated from the. Your yellow is your entry and green is your target, because green is the color of money. We like green. Green is also the signal that allows our vehicles to go beyond a point, and red is stop there. So the red signal on the road tells us to stop. Similarly, it stops us out of our trade. Remember, please place once your entry is confirmed, please place a GTT order for target and the stop loss so that you don't have to keep watching this. Remember, this is swing trading. We are not doing intraday trading here. So you don't have to be a trading monkey. Uh, if you are an intraday trader, I don't mean to call you monkeys. I do intraday trading myself whenever I get the time. But if you are chosen swing trading, then why would you need to spend so much time? And there's no need to get stressed out because we are going to be profitable over a number of trades if you follow price action correctly. So, you've studied this pattern before the market opened. Okay. You see this, let's say 2nd February. 2nd February, once you're back from your job or business or whatever it is you do, after post market close, you've analyzed this chart and realized I see a double bottom. Place your buy order in the system for an entry above 139.80. Give it some buffer. And next day when the market opens, all you need to do is open your broker app and see whether the order has been executed. If it has, you already know what your take target is. You already know your SL. So place a one cancels another order and obviously put in your authorization, your daily authorization for stop loss as required by most brokers. And then go about your daily business. You don't give a damn. Price is going up, price is going down, price is going up, price is going down. Again, you have a small bullish reversal here. They're trying to reverse, but they can't. Bulls are here, and then bulls finally you got a doji candle. You don't give a crap. You are into swing. You know your entry, you know your target, you know your SL, and the hell with it. Let the market do what it does. And you have one candle with huge volumes, almost 123 million, almost three times the volume, the daily volume. And then you have a gap of opening, and you have already, you have already, uh, in fact, on 1st March itself, if you see the high is 150.65, and if your target is 150, you're already out of the trade with 7%, right? With 7% or 7.63. Don't go into the particulars. This 7.63, so this is also, if I drag it, it'll become 7.60. Don't go into that nitty gritty, but you would have already been out of the trade if your target has hit. If not, you would have got the target here and you're good to go. All done. So that's the benefit of swing. You can do analyze charts in your off time, place a buy order, keep your stop loss and your target written in your mobile notes or in a notepad in an actual hard notebook. And as soon as your buy order executes, you will obviously just check your app. For me, I'll check my kite app and it'll tell me order executed. My GTT buy order has executed. Now I put a GTT for one, cancels another. I'm good to go. I don't watch it. I don't watch my trade. I will only watch it once one day has ended, and I will decide whether I need to trail my SL or keep it as it is. I'll just study what's happening with the market. What is the RSI? What is the MACD? What is the ATR? What is the ADX rating? Where are the EMA 20, 50, 100, 200 lines going? I may want to look at pivot points. If you want, you can look at Bollinger Bands, but don't need to be watching or tracking your trade on an hourly or a minute by minute basis. You are not into intraday trading. Now, I hope you learned something useful. Whatever I'm teaching will help you to make money. If you are a follower and if you are a serious student of trading, whether swing or intraday, if you follow price action and if you understand the risks involved, if you follow discipline, risk management, trading psychology, you will make money over a period of trades. But uh, but trading is risky, so obviously consult a certified advisor if you will. I've already given a disclaimer at the beginning, and I hope all of you uh, basically learn to enjoy reading the charts and taking effective action using price action. If you like this video, please like it, subscribe to my channel, forward it to other serious people who are seriously interested in trading. And I hope you learned something today, and thank you for watching. I'll see you in the next video. Bye, friends.